This is our Suburb Trends Report for March 2024, and we'll be looking at what property investors need to know when they're looking at investing across the country. And in this episode, we'll be looking specifically at the rental outlook for 2024. Will the pressure ease, and if so, where? Or are tenants in for another bruising year?
Welcome to The Elephant in the Room. This is the podcast where we love to talk about the big things in property that never usually get talked about. I'm Veronica Morgan, real estate agent, buyer's agent and buyer's agent mentor, co-host of Foxtel's Location Australia, author of Auction Ready and co-host of Your First Home Buyer Guide.
And I'm Chris Bates, mortgage broker, recently ranked number 5 in Australia out of over 18,000 brokers in the annual MPA Top 100 Mortgage Broker Awards. Before we get started, I need to let you know that nothing we say here can be taken as personal advice. We always recommend you engage the services of an appropriate and experienced professional.
This month, we've asked Kent to look into the outlook for the rental market in 2024. So, Kent, can you kick us off briefly explaining how you've tackled this challenge?
Yes. What I've done is a report that went out in the through the News Limited mastheads a few weeks ago. And they asked me to do some, they asked me to do some forecasting, and I forecast based on an SA3. I tried to do the model at an SA2, a statistical area 2 first. A lot of volatility. Those models don't behave too well. Moved out to the SA3. It projects a little bit better. All the statistical stuff looked pretty reasonable. That forecast out 12 months in advance, using a training data set that forecasts what it was today, and then using data up to date to predict what it would be in 12 months' time, all things equal. What I quickly learned was the housing market is going to increase, but nowhere near the rate of increase that the unit markets will increase, in theory, according to the model. So what I did is I took the growth rate forecast for the SA3 as the parent, then I took the current trend for the SA2, blended them together to come up with a forecast. The fascinating thing was the gap between the price rise and forecast for houses versus units. The theory I have is affordability. It's that people are being crowded out of houses and being pushed into units. So that's really the big driver. And probably the second piece is that a lot of unit markets are near that 20, 21, 22% mark. So they're relatively affordable, or have been up until now. Now, towards the end of this year, I'm forecasting that most of the capital city markets, I did my little capital city thing because I knew you would ask me, most of those capital city markets are going to nudge up around that 30% mark, and some are forecast to go well beyond that. So that's the summary.
So before we sort of kick on, I can see Chris has got a really in-depth question to ask, and I've got no doubt it's going to be riveting in that you're going to explain it and our minds are going to blow. But my brain, I'm just realising how biased I am to sales data. My brain just goes to sales data as you're saying that. So can I say, in case the listeners are as biased as me, that we need to keep sort of peppering the word. You're talking about affordability from a rental point of view, and you're talking about rents rising for units at a much greater rate than for houses, because the actual sales data is completely opposite. So let's sort of, I want to bring it back just in case I might be the only one. Everyone else is going, yeah, Veronica, we know, we heard you, but my brain is it really is struggling here, to be quite frank.
Well, rents are fantastic because they're easier to measure in that it's a percentage of household income allocated to rent. Sure. So it's an easy metric and it's uniform. If the Google algorithm on YouTube picks up that you're interested in this topic, you'll see the same thing measured in the UK, the US, wherever you are. And the standard globally is 30%.
That actually brings us into understanding clearly what you're measuring there, because rental data is not gathered and calculated and reported on in the same way that sales data is. So can we sort of get an understanding of the difference there?
Yes, this is based on advertised rents. There's different ways you can collect rental data. There's been a few experiments we've done over the last 25 years looking at ways to collect rental data, but we've concluded that the most robust method is to use the advertised rental rate. What I have done in this particular case is measure it at a statistical area 2 level, suburb areas, because they're slightly larger, a little bit more robust and a little bit better behaved. There are a lot of suburbs where you've got enough rentals, but there's a lot of suburbs where you don't, probably 50-50 mix. Whereas when you zoom out that slight level to that SA2 level, most of your SA2s start to behave quite well. So we're measuring advertised rents. We're using a rolling 12-month median, so that makes it behave even better. So it's a rolling 12-month median, and we're measuring household income. But what I've done with the household income to look at affordability is I've applied an index to what it was as at August 2021 with the census. So there's an indexation being applied, rounding out, that's around 20% growth of a household income since that period in 2021. So we've had indexation to the model for wages or for household income, and we've had rates increase all the way through until now, but then we've added a forecast for the next 12 months.
So, Kate, are you saying that, the houses' rents are likely to grow slower than unit rents, right?
Well, they're growing. They're all growing.
Yeah, but at a slower rate you're expecting over the next few years. Yeah.
Just the next year at this point in time. I'm not going beyond that 12 month, but yes. In short, yes.
I mean, it makes sense when you think about it logically. Yeah, just because of affordability. I mean, there's a drive to home ownership, but, there's, and having more space with home offices, I mean, and, a drive for space. But I just wonder if counter-cyclical, there's actually a more of a fall in the number of occupancy, right? So the number of people per property actually starting to increase, right? So people start to say, hey, actually, I can't afford a 2-bed flat. Now I need a 3-bed house or a 4-bed house because I have to go back to flat sharing. And, you start seeing that happening more and more, right? Whereas in COVID, there was a flight to, getting your own space and renting a 1-bed or a studio because you didn't want a flatmate. The second thing is with houses is that I just wonder if, every time a house sells right now, it's probably not going to sell to another investor. Borrowing capacity is just so tight. And investors are already struggling to enter the market because they've already got other debt, let alone enough money to then go and stretch into a house. And let alone do they have the, desire to go into a big negative cash flow, right? Because houses are growing higher than apartments. And so every time an investor wants to sell a house, whether they're dying, it's most likely going to an owner-occupier. So I reckon it's going to get even harder to rent a house. And then a lot of families are pushed out of homes, and they are getting pushed. And so they want to rent homes. And so there's that pent-up demand still there. So I sort of get the numbers and the forecast, but I just wonder if, as the behaviors of, people can't afford their rents, then they start to flat share, less houses for rent in 12 months' time, with whether this starts to even just surprise the models. Because you're right, that gap between house rents and unit rents, it's always, you think, maybe it's getting too unaffordable, people can't afford it anymore, but maybe they can afford it if 3 friends come together now, rather than a family being the typical renter. So maybe it becomes more of a dorm house rather than a family house. And, typically that's not what we've seen in Australia too much. Yeah.
We're seeing a lot of headlines, a lot of it at the moment. I think every second story I'm reading is covering house sharing as a standard, because it's your only option. Once you get above, you get some markets where the average household income allocation to rent, it's up above 40%. So in those markets, you've got a scenario where either you share or there's displacement. And that displacement means you can't afford to stay there. Therefore, you exit. Who comes in? And it's either somebody else comes in with a higher household income, which we can only really measure next census, or vacancy rates go up and prices come back down to match what people can afford. At the moment, I've just finished a little bit of a desktop analysis before this podcast, and there's not a lot of. I was trying to test a scenario where when affordability got high, when affordability got poor, if you know what I'm saying, above that 31, 32% mark for a prolonged period, what happens? Do listings go up, or what are some of the scenarios? And I couldn't find any pattern in the data at this stage. So it indicates to me that there's replacement, there's displacement and replacement, and people coming in have got more money and pushing those with lower household income out into the scenario that you just mentioned. They're either going in with family or going into house share.
And I think, we sort of the markets are always evolving, right? So, we had our 600 square, 800 square meter block, and everyone had that, 10, 20 years ago, blah, 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 right? And, living standards having to change. I mean, I sort of can see that, brothers and sisters and families and multi-generational houses, are the way that families might be able to buy in the future. And also, I mean, when I was living in London, I don't know if I've ever shared this on the podcast, when I first moved there, I think there was like 20 people living in a 5-bedroom house when I was in London, right? And it's quite common to be not just sharing a house, but sharing bedrooms, right?
That's like that
and,
Young Ones
people
TV show.
Yes.
But, and you have, so because the cost of living there, like the salary plus the rent plus the cost of living in the city, like, yeah, you had to share a bedroom. And I know that not everyone would want to do that, but it's not just sharing a house, it's actually sharing bedrooms. And I think this is potentially the direction we're heading in, right? If we don't do things to solve a rental affordability crisis, people will make those compromises if they're forced to. And I think that's what we're seeing, better than being homeless, right? And that's what I think we're heading down.
I think it's already happening though, isn't it, in many places? But I think that's interesting though, because this is unprecedented, that word again. We can look to more expensive markets across the world. And obviously London is well known for having very expensive real estate. And I've never lived there. So you've had that lived experience, Chris. I mean, I know I've seen, there's been certain parts of Surrey Hills, for example, when I was first in real estate, or first as a buyer's agent, and right down the bottom, the rag trading end, and there was lots and lots of students living in these houses, and you'd often go in them and they had bunk beds in the bedrooms, and there'd be 4 people sharing a room. Now, they were students, but I guess that's what you see happens when you've got affordability problems, right? I reckon some of these were shift beds as well. It's like somebody works at night and then somebody works at day. I mean, that's really an extreme, but going into these houses where you've got 16 people living in a 4-bedroom house, it's pretty shocking. But it's not unheard of. And I guess if we do have to point to look to other cities where perhaps this has long been a problem. But I think that it's interesting about the house and the unit divide. And I agree with you, Chris. I think that the signs are, for lots of reasons, and the reasons that you pointed out, and land tax is another one, that it's more and more unattractive, certainly for new investors, to buy houses. Old investors, if they've got enough equity and they're not paying a mortgage, perhaps might hold on to it as being great assets, if they have great assets. So you're not going to be seeing, you're not going to be seeing an increase of investors typically buying houses. That's been the case in Sydney for some time. I would hazard in Melbourne probably has as well. And as Brisbane becomes more expensive and other cities follow suit, then that's going to be the case. But it's interesting because you talk about units and you're careful to say that's just for this year. And I get why, Kent, because obviously with more supply, you're going to see downward pressure on rents in the unit space, that's for sure. But what else, what else are you seeing? Can you interpret anything else from the data, or are we just got a hypothesis at the moment in terms of what people are doing and where they're moving? And you said there's no pattern in the data. Is there anything that is different that is measurable?
Well, there's certainly consistency in that first component part of it. That is, we're seeing substantial increases in rents for units across the board. There's a couple of geographical standouts here, and I'll just focus on the capital cities for a moment. Forecasting 0% increase in house rents in Hobart. So that's quite interesting, right. And a 12% increase in unit rents. But what's probably the most interesting metric of all of the capital cities is the affordability of units in Hobart. And that's at around 19% of household income. So if you're doing it tough trying to rent in any other capital city and you want a bit of a change, I'd eyeball Hobart as a viable option. Absolutely. So that's probably the standout. The other one is the affordability ratios are getting into very high percentages. So we're looking at Sydney houses up around 39% of household income at the end of the year on average. So as a result of that affordability metric, it's likely that there's two scenarios to play out. Chris, you covered it. House sharing, or you're being displaced and replaced by a wealthier family. So that change to Sydney has a lot of the pattern about it of San Francisco, in that suddenly it's a place for rich people only, and good luck finding a barista or somebody to pack your shelves at the local Coles or Woolies. So that's a scenario in Sydney, and units are forecast to accelerate with their rental price increases and get to a very similar level of affordability at around that 37% mark based on this model. Models, I think we all know these models have their limitations, but
we should probably preface it by saying we don't like to forecast on this podcast, but here we are.
Yeah. Well, look, it's a trend line that's been pretty consistent. So I've been looking at it over the last 15 months, and it's like, okay, could it continue at this rate for the next 12 months? And at this point, because supply levels are so low and population growth has been so extraordinarily high, I think it's a fair assumption to say that trend is going to continue.
What about other cities? Tell us.
Yeah, so I'll go down the list. So Adelaide, I've got houses jumping by 13% in the model, units by up to around 30%. But with units in Adelaide, they'll still be, even at that increase, they'll be around 26% affordability. So when the affordability is still quite low or acceptable, I have a little bit more faith in that forecast or that prediction. When it gets above the 35% mark, my confidence goes down. ACT...
And that's because the market doesn't necessarily have the wherewithal to sustain that growth. Is that what you're saying?
That displacement replacement theory that I'm trying to build a model around it to test it. And but the theory is if you're in an area where it's no longer affordable for you, but you're in an area where the household income is very low in comparison to the neighbours, it means the neighbours can move in. So an example of that, a crude example would be if I'm in a suburb and I'm at the lowest ebb or comparison to the rest of the SA3, for example, if I'm in one of the lower household income suburbs, it means that I could be forced out by higher income neighbours, and that can be measured and modelled. So I haven't built any sophisticated model for that yet, but that's the theory, that the areas the suburbs that do hit that 35% mark and higher, that could still spell ongoing rent increases if they are in that situation.
Kat, I mean, what we're sort of seeing from an investor point of view is absolutely investor numbers are going back up. There's an appetite for people who have got equity, who have got a bit of a buffer, who have got good incomes. It is unfortunately very highly skewed to people who are on higher income, unless they've got very, very low debt compared to their income. And usually those people who've got very low debt to their income are usually higher incomes. So they're at a point where they're going, rates are likely hitting peaks. I do need to buy an investment property. I know I've been do it for years. Maybe I should get in before rates come down. Like that's kind of what their mindset's thinking. I need to do this. And their house prices have built a bit of equity because, their houses have gone back up in price a bit over the last 12, 18 months, and they've paid their mortgages down, over the last 5. So they've got this equity, they've got this buffer as well. and they've got enough borrowing capacity to go and buy an investment property. Now, some have got a great borrowing capacity, but a lot of them don't. And so they are entering, but I would say that a lot of the investors are entering on the lower end side, and they're wanting to, because they haven't got much capacity, right? And they're a bit worried about cash flow, to be honest. I wouldn't say we're not encouraging this. I'm just making it clear, but that's what we're seeing. That's their mindset. However, on the other side, we're absolutely seeing our clients who have got investment properties are selling. And, Pippa article that we did, or not article, an episode, that went absolutely nuts on YouTube, to be honest. Nothing we've recorded or published has gone anywhere near that amount of views.
I know.
But I think it was like 50,000 or something last time I looked at it. And that must have really hit a nail in, why, I don't know why it was so viral, but, that episode really highlights, why, nerve now, let's say, we'll go with a nerve. But I think why did that? And I think because it is the truth. It's what investors are absolutely doing. And, if you're like that replace, displace theory you've got there, yes, more investors are entering, right? And you can see investor loan growth is getting stronger. And, we can see that on the ground. We can see the appetites change, see inquiries changing. Like these are leading indicators of what's going to happen over the next few years. So we think the investors will be really strong as rates fall. And I reckon they'll push out first-time buyers in a lot of areas because they've usually got a bit more cash and borrowing capacity. But I don't reckon they're replacing the investors. And so in these models, are you factoring in like rental listings starting to decrease? Because if more investors are buying than first-time buyers, right, and investors are selling, how does this sort of going to affect our sort of supply numbers?
Yeah, I saw a slight dip in listings, but it's not been significant enough to make a call on at this point. So that was only half an hour ago where I was looking at the averages month on month over the last 6 months. And I saw a couple of little periods there that could have been seasonal. So I've not seen sufficient evidence to make a call or a judgment on that at this stage.
And the only other element of that is that, usually what you'd say is, okay, there's all this investor stock coming, right? Because there's all this high density stuff that we've been building that's all going to come on, right? But, those towers aren't going to be for investors. A lot of the new stuff that's getting built now is not so. There are obviously still high density pockets, but I reckon those developments are slowly finishing. There's not like new ones have been able to get the sales. But the high density stuff that is coming is more down to the downsizers, right? It's more the higher end because that's the only stuff developers can build because it's the only stuff they can make margin on. And so I don't think there's this, if investors keep bailing, it's not like we're going to replenish this with lots of new high density apartments over the next 5 years. It's a lot of developers just can't make money on that stuff. So that's going to be another issue.
$700,000 and $800,000 plus units don't solve rental affordability problems.
No.
They don't. Not if I'm expecting a 3.5% yield.
Yeah. And the build to rent stuff is very infancy, right? The developers aren't, it's just trying a few projects here and there. And I think the pipeline for that is like 30,000 at best at the moment. And when you've got 11 million dwellings, it's such a drop in the ocean.
Not enough. I mean, it sounds crude, but more than 6% of people in the US live in villages, mobile home parks, and less than 1% of us, less than 1% of Australians living in caravan parks. So if you want a fast solution, you want a low-cost solution, there is a solution at hand, and you could use government land and do a leasehold, and you could really rapidly roll out something that's affordable, that's deliverable because of prefab, and it doesn't need to be low quality. It can be a high standard. So there are options, but we keep on going back to the same, looking for a solution using the same things that we've done for the last 30, 40 years. And I listened to a very interesting podcast by the prefab manufacturer called ICON, IKON, in the United States. And he made a really interesting statement, that the founder, and he said, if we are looking to manufacture and produce houses in the same way we have done for 100 years, prices aren't going backwards. Things won't get better now. So if it's a problem, it won't get better, and we won't solve it with the same approach. So we need a radically different approach.
Well, that's true, but we seem to be not really getting any solutions from our governments. That's for sure.
No.
Negative gearing's back on the table, and we're bringing you a considered episode on that very topic in the next couple of weeks. And you can see that that's increasingly coming, being discussed. And I just think at the very first thing we should do is try to stem the tide of investors selling out.
Really?
That's something to try to do, to actually try to at least hold the amount of stock we currently have at that level, right? That would be an achievement instead of what's happening, like Chris is saying, that the amount of new investors coming in aren't replacing the ones that are aborting the system. So that's one thing. And in terms of, you've come up with the Nissan Hut idea many, many times, Kent, but it doesn't seem to get any traction. So can we continue through the capital cities? Because, we've got to sort of Hobart and Adelaide, and we keep talking. So let's just...
So Brisbane, 11% houses, up to 30% for units. But why I'm less confident of Brisbane is that pushes the affordability metric up to 39%. So very low confidence there. Melbourne...
So something's got to give.
Yeah, yes. And I don't... it's the displacement theory here, because a lot of people are moving up from Sydney. So yet another one of my friends selling up, living in, he's at Haberfield in the inner west. So selling up to move to a very nice suburb in Brisbane because it's affordable, air quotes affordable.
It's always been a driver of migration from Sydney and Melbourne to Brisbane, that affordability piece. From owner-occupiers' point of view, we're not talking about tenants so much here. If you can get a good paying job, and you can get, a job at the sort of level that you want up there, pre-COVID, pre-work from home, all that sort of stuff. We had lots of clients that would do that over time. And it was aspirational in a way. If I can go there, I have a better quality of life. I'll argue that maybe don't, but that's just because I'm an inner city dweller in Sydney. But, that particularly for families, I've got more space. I can get a house rather than an apartment. A mortgage is lower. I might have a less paying job, but I've got a good job, and I'm at the point in my career where I'm not trying to climb the ladder. Then off we go. And that used to be a big drive of people moving to Brisbane.
Yeah, well, I did the Brisbane move and then lost the job and couldn't, and that was going back a long time ago. Things have changed dramatically since then. But it was still a country town 35 years ago. So it's a beautiful big city now. Moving on, Melbourne, plus 15% for houses, taking up to an affordability ratio of 29%. So that's good. And I think that's been a hallmark of Melbourne for some time now. And units plus 27% going up to an affordability ratio of 29%. So I'm feeling rather confident that is likely to happen. Not happy, but confident that it's going to increase by that type of level. Perth houses 16%, affordability 32%, so quite possible. And again, because you got that displacement, you got a lot of people going there, being pushed out of Sydney. So there's a possibility there that a household income could go up with higher incomes, and units forecast to go up by 30%, but the affordability at 37% makes it less likely to get that high, in my view. I don't know if I've covered Sydney, but I'll mention it again anyway. Sydney plus 16% for units going up to 39%. So it's extraordinary.
Cool.
And I don't think that's feasible. One thing that's going to happen, once you get above that 30% mark, the reality is there's not much money left over to go to a cafe or go to a restaurant. And if you know people in the retail trade, as soon as interest rates go up, they feel the pinch. They know the restaurants are less bookings, and the market stalls do half the trade they usually do, and I think that's a big problem for Sydney. It's going to be a big problem. It's almost lifeless now. A lot of people say it's not what it used to be for restaurants and vibes and clubs and whatnot, that will really make that situation even worse if we're spending up to 39% on average on rents,
Right.
and units, 33% increase forecast going to 37%. So that's extreme. And as I said, because it's up around that 37%, it's less confident. So yeah, quite an extreme situation.
That's 30%, 37% of household income.
Of median household income.
So a median, not price rises or rental rises. But this is interesting because Sydney is the most expensive city. So therefore, there's no one going to be displaced to Sydney, are they?
No.
They're going to leave here to go elsewhere.
They're leaving Sydney and they're pushing out to the other capitals, but they're also still migrating to the regions and the regional cities. So I'm in Newcastle, as you know, and there's a steady flow of people moving up here.
Yeah.
So we're definitely, I wouldn't say last year, but I would say the start of this year, the rhetoric around getting out of Sydney happening again. The 2021, obviously it was 2020, 2021, it was like, who wants to stay in Sydney? Let's just move. I can work forever from home. 2022 was like, 2022, it was actually, prices are falling. I don't want to leave. I don't want to buy, blah, blah, blah. And then 2023 was, I want to stay close to the city. I'm not sure about my work. And, I don't think I want to move up the Central Coast or North Wollongong. Like they would just, our purses just, they shifted like this. But absolutely, they have come back to the start of this year. I think the late last year, they started missing out again. And they're like, actually, I don't know if I really want to live in that long term. I know I'm going to have to commute. So it's back to kind of the compromise is I actually know I have to make the commute. But, one of the things like of those markets is the amount of influx of younger families. Typically, that's a lot of people who make these big lifestyle moves. Like, while you're still single, you're in a couple, like you want to just still be in the action. It's like when the urgency is there, when you've got a need for space and you want to get community and stable, that drives people to go. Or maybe they're like thinking about having kids, so they're like trying to be well planned. I mean, childcare. Try to get a kid into childcare in Central Coast. Like, just you cannot get them in. Like, I've got friends up there who just cannot get their kids in childcare. They've been on waiting lists for years. They're just full.
They'll be at school by the time they get to the top of the list. Is that what you're saying?
We got a phone call. We were in Balmain, and we tried to book our boy in 6 months before he was born, and we'd long moved, and we got a phone call when he was 3.5 saying, "We've got a spot for you."
I remember those days.
Yeah. So I think that's one of the issues that, when these regions or, the demographic really shifts fast, the schooling can't keep up, the childcares, the hospitals, all these sort of things, the doctors. And so I think that's what will have to happen in these places as well is that, and I think it's going to come back. It just makes sense as people get forced out. They're going to start to go up to Central Coast again. They're going to start going up to Newcastle. And I do think that's good for their economies, right? I think that people will start businesses. There'll be, but predominantly they don't want to walk away from their city incomes, right? To transition up there, and so they're going to try to have to do the commute. And is that really the life that they really,
You can do that 1 or 2 days per week. I was doing that for CoreLogic, and I was traveling down and staying 1 or 2 nights, and it was quite a comfortable scenario doing it that way. So if you can find accommodation, you can stay a couple of nights down there. It's quite workable, but you cannot do it daily.
And is it easy to get accommodation, or, is it cheap? Like the hotels that, that's what I meant. It's not that, I do think the attack on Airbnb will be coming up in New South Wales very soon. Yeah. I think it's just, they're going to have to do something politically, and it's one of the easiest ones to target. So I think there'll be an Airbnb tax similar to Victoria very quickly in New South Wales.
I agree.
The 7.5% down there, it sounds like it didn't, it's kind of sailed through. No one really got too upset. So why don't we and the government wants more taxes, right? So I think that's a win for everyone there, besides the Airbnb owner.
I read something a few days ago about the vacant homes on the census night, how we spoke about it. We said, hang on, we don't know why they're vacant, so don't jump at shadows. Yeah. And a report came out only a few days ago, thought, oh, we got that one right.
So this displacement from tenants, though, is that new? I mean, we've known about displacement from a owner-occupier point of view for some time. We've seen it, right? But is this tenancy displacement a relatively new phenomena? That's and I guess the fact is that they're more mobile by definition anyway.
Yeah, and that's why the rental market's such a fascinating data set to work with because it's so fluid. It's a pure market. In the past, however, we've seen always had access to markets that had higher vacancy rates. So what used to vary a lot was vacancy rates. Yeah. And, so when you had a vacancy rate that was fairly standard of 2 to 3% or 3.5%, when prices went up too high, you could see vacancy rates vary within the region or within a few suburbs away. So there's always that cushioning option. That's disappeared. We've just wiped out. You've had getting used to thinking that vacancy rates are below 1.5 or below 1% are normal. They're not. It's like we're getting used to inventory levels being below 2 months of stock. They're not. So we're doing this. That's why I say, I know people criticise and say it's not a supply issue. Well, I think it's a supply issue because demand's so high. Okay, if you can deal with the demand, happy days. But the issue is, I've not seen numbers like this to tell me it's a supply issue. There's just not enough rentals. There's just not enough properties for sale, and prices will continue to grow as much as people can afford to let them grow.
Well, that's the thing, isn't it? I mean, and then there's it's market forces for you. But interestingly enough, because I mean, the rental data that you're looking at is all relative, right? It's a relativity of what's advertised. It's a relativity of matching that against census data, and so it's an aggregate, right? It's not saying, oh, if you go to rent this 2-bedroom apartment, it is going to be X percent less or more than it would have been a year ago. So it's a different measure or a different figure, right? Because we do have an issue. It's interesting because the New South Wales government is in the process of rental reforms, and so changing legislation. And one of the things that they're looking at in this legislation change is a way to have timely and accurate rental data for tenants. And when I say for tenants, is because they've recognised that a tenant is in a position where they're lacking power, but information is power. They're lacking the access to information to determine if their rent is increased, whether or not that's a fair increase or not. Because when you look at, say you want to do a comparison, a rental appraisal on a property, and you say, right, I've got this 2-bedroom or 3-bedroom, whatever it is, property, and I want to go out and see what's a reasonable rent to ask for that property. You go out and online and you look for the data, and all you can see is what was advertised. So you're not seeing what ultimately rented for, nor are you seeing if that property has had the same tenant for more than one lease period. You're not actually seeing if they've had increases or anything like that. That's not captured anywhere, and it's not reported anywhere. So the New South Wales state government is looking at ways to make that more transparent, so that tenants have got better information, so they can claim that a rent increase is unfair, and then they can go to tribunal. Interestingly enough, I think that information, that transparency of information, is actually a good thing for landlords and also for property managers as well, because property manager is, when they're doing an appraisal, when they're advising their landlord or their owner about what rent is reasonable, they've only got access to the same information plus whatever's internal in their database. So this is a real issue. Whereas when you're going to buy a property, the actual sales data is available, readily available, and it's reliable, and at worst it's 3 months old, because that's when it goes to the Office of State Revenue. But generally speaking, it's actually quicker. It's much more timely than that, and it's reliable. So there's two different types of rental data, I guess is what I'm talking about here. There's the rental data you're looking at.
I don't think it's as big a problem as they're pointing out, and I do not think that
okay, interesting.
I don't think it's going to be anywhere near the solution that's being proposed, because you've got so many rentals. You've got enough rentals that they become statistically significant very quickly. If you're tracking the trend and you're looking at how prices are trending, medians are trending, if they're really well normally distributed and you do that, say, at an SA3 level, you just index what your last rental appraisal was by that.
Right.
And that's readily available here and now without any, exhaustive amount of work or expense on behalf of the government. So I'm going to call it and say, so what? I don't think it's that big. I'm not that excited about it. I don't think it makes that much difference.
Oh, that's interesting. Even from our point of view, as when we're looking at a rental appraisal on a property, we approach it much the same way we approach a sales appraisal. So you're suggesting that it's actually that's overthinking it.
Totally overthinking. You've got an abundance of available comparable sales. So you can do a rental CMA in most areas much more easily than you can do a sales CMA. And you've got the other advantage of the ability to index, and the indices for rents are great. So I'm going to call rubbish.
Well, that is interesting. So I wonder, because the legislators don't tend to go to the marketplace to find these things out. They tend to make their own minds up, right?
Oh, no, the rental commissioner talks to me all the time. Just hasn't asked that one.
Well, in that case. But that's what I
haven't
mean.
been asked
if they
about
haven't asked you that question, yeah, I mean, that's in their document as to one of the things that they are looking at addressing. That transparency of information from a tenant's perspective. I know you're rubbishing it, but the reality is that it could well get through because I didn't rubbish it. I went, yeah, that makes sense to me, and I'm not a data expert clearly. So
I just say it's not going to make much difference at all. There's bigger problems.
Okay, so it's going to look like they're doing something, but they're not really. But the problem is, though, what their solution they're proposing is going to be onerous to the industry. It's going to require more reporting, and it's going to require some sort of central portal that this reporting can be done into. And so that is going to put places, as they often don't want to do, which is place a burden on the industry. But that's right. One of the solutions.
And if it costs money, who pays for it?
The tenants.
Right.
Probably, yes.
So this is where we get it wrong. This is the big government mindset. They just don't understand how markets work.
No.
Elephant in the room, man. Elephant in the room, if ever there was one. All right. Well, anything else you want to add to this discussion, Ken?
No, we just need a solution that's real, not moving numbers around or shuffling paper. We need politicians who can really do something. And we don't have any.
Disheartening. And I know this has not been our most positive episode in the 300, but you can be frustrated when you can't afford to buy. Maybe you can't really be frustrated, hey, I can't buy that big house on that best street. It's just, maybe that ship sailed. It's a bit too, you shouldn't really be getting upset if you can't own that $100 million mansion. But if you can't rent something and
that's pretty bad.
And you got to be 40 people and you just keep getting outbidded for rent. And, you're doing an amazing job in the community. You would be a great tenant, but, on paper, maybe you're not as strong as someone else, right? And you just keep pushed to the bottom. And I think that is so stressful. What do you do? When your lease is running out, you get given 4 weeks notice, I'm selling, my tenancy's up. So I think this is, I'd love the rental security of one of the things that drives our prices, I would say, is just how bad we are at longer leases at 10. That rental uncertainty is what absolutely forces people to, pay to buy. And that's why our yields are so low. If you could buy rent really easily, then you would say, well, the cost to rent versus buying doesn't make sense. I'm just going to rent, and that would push up our yields. It's just that the risk of renting is so large, so people will just go and pay ridiculous amounts to get home security. On top of that, then that is self-fulfilling, because when you get that home security, you get capital growth. So that whole thing just continues. And so, yeah, it's so hard to flip
the solutions are, we don't have to find unique solutions to Australia. The solutions are all over the world, and America's got some really good things going on, right? So they've got their multifamily, which is their word for build to rent. There's a lot of ma and pa small investors that own whole blocks of units. And there's all levels of incentives, tax incentives, access to finance that really have created a flourishing multifamily market that is not just Wall Street corporates that are doing it. So, your average investor over there is building 5 to 10 to 15 units and renting them out with all sorts of tax incentives, depending on what they rent it for relative to market. So if it's below market rate, they get extra tax incentives. So it's a very sophisticated system that we should be all over. We should know every ounce of how that works. And the second point, as I mentioned, less than 1% of Australians are living in caravan parks. More than 6% of Americans live in mobile home parks.
So that might be the future. Is that what you're suggesting, Kent?
Well, it's just one. It's just one of many, and we need the prefab. We've covered the prefab many times over. So, we need prefab. We need 3D printing. We need a multifaceted approach, and all we seem to do is just gravitate back to let's use the same things and come up, try the same solutions over and over again. When the horse is bolted, too expensive to build. You can't. A $700,000 unit doesn't fix it.
Yeah, and I think this is why Chris Minns, hats off to him for being pretty brave. The way he's been, with taking on the NIMBYs and the ingrained capitalism within governments and, the key communities around Sydney. He's just like, stuff you, I'm going to rezone, right? And so
he's having a crack.
Exactly. And I think that's, hats off to him. You can't argue that he's not up for the fight because he's absolutely up for it. Whether it's the best way to go about it, or whether, everything he says is going to get approved is actually going to happen, but you can't argue with his confidence. So we'll see how this one plays out over 2024. It's a big story, that one. And every time I see his name, I want to see exactly what he's saying. And I read the article because I do think it's a good test case. If this Sydney thing happens, you can start to apply those same reasons in the future in other capital cities. You say, well, this is what happened in Sydney when things got really tough. Actually, that similar things could happen in Adelaide, it could happen in Perth, could happen in Brisbane. Melbourne already pretty relaxed, but it's those same. So then when you buy and you invest, you can say, actually, we've got to prepare, and I'm holding something for 20, 30, 40 years. I've got to prepare for the world where things like this are going to happen. I can't rely having a good piece of land in this area. It's just going to be like that. I need to know that if it's near a train station, that could get rezoned. It could be a positive or a negative, but I need to consider that. So,
But therein lies one of the problems, is that it's a movable feast in many regards, and certainly from an individual investor to invest in something that's a block of units or even an individual property, you need a level of certainty. That thing that the ground is not going to move under you. And I was just thinking as we were talking, as just leased a house that I've got in Alexandria last month, and I think I've told the story on the podcast before. And, I'm thinking to myself, I'll happily offer them a 24-month lease. But to be honest, a lot of tenants actually, they might say they want long tenure, but they don't really want to commit themselves to 24 months either, equally. So it's a bit of both ways here. And, and my memory is fairly fresh too of how I was bent over a barrel when COVID hit and investors had to really cop it and severe rental cuts to rents. So investors, one of the reasons investors are selling out is because, they're still bruised in many cases. And
if you owned in Docklands for the last 20 years, how would you feel?
Yeah, I haven't had any capital growth, and
and you had a long period of high vacancies as well. So, they're only just starting to see some sunlight. You're
going to milk it. You're going to make hay while the sun shines, and it's not about greedy landlords or the rest of it. It's just that there's not much rhetoric around when landlords are copying it. You don't get the same sympathy. So, and it's not to say I'm not sympathetic towards tenants, absolutely sympathetic towards tenants. I think it's a disgusting state of affairs. We've got families and people can't afford or can't find, forget whether they can afford it or not, they can't find places to rent. I think it's disgusting. But at the same time, I think, we've also got to remember that landlords have not been treated particularly well. As I said, with this negative gearing argument coming up now, where we're girding our loins for another bashing.
Oh, I'd like to hear what Paul Keating's got to think about that. He's got a little bit of experience in that domain. All right.
Thank you, Ken. Thank you, Veronica.
We'll
Thank
talk
you.
soon.
Thank you.
Thanks for listening.
See you next week.
Okay.
If you have a question that you'd like us to answer in an upcoming Q&A episode, you can send us a voicemail or written question via the website, theelephantintheroom.com.au, or you can email us directly at questions@theelephantintheroom.com.au. If you like what you're hearing, please share this episode with others you feel would benefit. And while you're at it, why not leave us an iTunes review? 5 stars would be great. I know that sounds a bit cringy, but we have it on good authority that every review helps make it easier for other people to find out about us and hear what our amazing guests have to say.